Ladies and gentlemen, please welcome to the stage Head of R&D for Discovery Life, Gareth Friedlander.
Good morning everyone, and welcome to our annual Claims Roadshow for 2019 and reviewing the 2018 year of claims. Thank you to all of you for your attendance. I think these claims roadshows are what it's all about. You know, we tend to talk a lot about, the various engagement metrics, and I'll give you some insight into that. But I think claims and being there for our clients at the times of needs and seeing how that plays out is probably the most important roadshow that we give throughout the year. Also, we, as you know, are about 3 or 4 weeks post-close-off for our financial year. And while the dust settles and our actuaries kind of furiously work through all the numbers, we're starting to see tremendous results coming through. And I just wanted to thank each and every one of you for your incredible support and friendship. It's been a remarkable period for Discovery Life, and I'll give you a little bit of insight into some of the numbers as we see them coming through over the last few months. In terms of today's presentation, I'm going to very quickly give you a short business update before handing over to Dr. Marita van der Walt, our Chief Medical Officer, who will give you some deep insights and trends and case studies around the claims experience from last year. So from a business perspective, as you know, it's been a remarkable period of activity for the group. I think with the rollout of the bank, several businesses introducing new products and businesses across the group over the last 12 months or so. The shared value model is operating and firing on all cylinders. I just wanted to take you through a couple of key milestones that have happened over the last few months. First and foremost, some of you may have heard 2 or 3 weeks ago the announcement that for the first time the Vitality Group is entering the 6th continent. So we've now entered South America through our joint venture with Secutsa and Equivida in Ecuador. So now Vitality is currently being sold into the South American continent. That's the 21st country in 6 continents where this shared value insurance model is now playing out and very quickly starting to become the preeminent new category of life insurance globally. From a local perspective, as of next month, as of August, we will have paid 5 billion rand in paybacks. It is a phenomenal number. I still remember giving presentations where we were kind of reaching the billion rand mark. And in the blink of an eye, it kind of goes up to 5 billion. We're now paying about 1 billion rand a year in paybacks, and I think all of you have either received your own paybacks or certainly had clients who've received these paybacks. Payback is the physical manifestation of shared value. Clients become healthier, it generates actuarial surplus, and that surplus is passed back to clients in the form of very real, tangible financial rewards. So it's incredible to see that kind of flagship feature playing out at such scale. From an engagement perspective, the levels are unprecedented. These are the engagement levels relative to 10 years ago, which was already good engagement. So you can see we've now got 5 times the Gold and Diamond clients, the Gold and Diamond proportions that we had 10 years ago. And clients continue to engage in the model and become healthier as a result. Engagement is really the lifeblood of everything we do. If you want to see if we're performing as a business, look at the engagement in Vitality. Everything kind of emanates from that. And then that obviously plays out in all sorts of rewards for clients. These are the 2018 rewards alone. So you can see over 250 million in flight savings last year, 1 billion rand in gym savings for our clients last year, and over 150 million through healthy food. And you'll see those ramp up dramatically as we roll out the bank over the next couple of months. That obviously kind of doubles many of those rewards and how they'll play out in the banking space too. So the shared value model, you can see delivering incredible milestones both locally and globally and becoming the kind of new category, new wave of insurance in the world. I think we've been saying for many years the concept of linking wellness to insurance is the most intuitive, obvious concept in the world. And I really believe that if you fast forward a decade, companies that aren't employing this type of model are going to find it impossible to compete. The industry on a local front, I don't think it's news to anyone in this room that it's been difficult times. I think when you look at the environment, consumer confidence increased slightly in Q2. We recently got the figures, but still 81% down from its levels at the beginning of last year, at the beginning of 2018, when Ramaphosa was elected in. And from a GDP perspective, we're hoping that when Q2 numbers come out in a couple of weeks, that there will have been a little bit of a recovery on the back of slightly more stable Eskom. But the Q1 number was the lowest that we've had in 15 quarters. So from an environmental perspective, we're operating against huge economic headwinds in a very difficult environment. And that's manifested in pretty high lapse rates across the industry. These are the NMG statistics, and you can see in the red line the industry lapse rates and then the relative Discovery lapse rate. And for me, this has been one remarkable outcome of the shared value model, is that in tough times, when insurance tends to be the first thing to go in a traditional model, insurance is the last thing to go when you've got this kind of consumer engaged model. When consumers are pinched, when they're kind of squeezed for disposable income, and it's their very life insurance policy that gives them access to all these types of savings and paybacks, that becomes the first thing they hold on to when times are tough. So it creates this huge kind of robustness against economic volatility, and we see that playing out in remarkable persistency across a very tough time, and that's been really, really positive for us. In addition, from a new business perspective, you can see, according to the latest NMG statistics, that the industry is stagnating, if not slightly contracting, at a kind of high level, down 1% as of Q1, the year ending Q1 2019. But when you dissect the data, it's a tale of two cities. Discovery, as of the end of Q1, has grown by nearly 9% in that 12-month period. And when you take Discovery's growth out of the industry, you can see quite a different scenario. You can see that the industry has actually contracted by nearly 5%, which is quite a dramatic decline in new business from an industry perspective. So there really is a tale of two cities kind of playing itself out. And for me, this is really driven through the shared value model, through innovation, through creating value for clients in a very real and unique way. And obviously that plays out in a market share space as well. Our Q1 market share touched 32% for the first time. The second biggest in the industry was down to now 15%. So you can see we're writing now more than 2 times the new business of the second biggest writer in the industry, and really accelerating away from the pack. And again, I think for me, this is all driven through innovation and through this very compelling and powerful shared value model. And these innovations continue to kind of accelerate. I think, as you know, launch new products each year, had a suite of special offers ending in June, and that's seen a new wave, a new acceleration of new business. Some of the highlights that I just wanted to take you through: the Discovery Bank Integrator, a new type of shared value model that takes clients' financial behavior and uses that in a dynamic pricing mechanism to provide large and significant upfront discounts, and as well as extra cover through the Vitality Fund over time. And we've seen that clients who have already taken out the Bank Integrator are saving on average 2,000 Rand a year as a result of that Bank Integrator product. Hopefully some of you have started to see the rollout. I think the bank are now at a point where they are taking on about 1,000 new clients a day, and they're going to scale that up over the next coming weeks. So hopefully it's going to be fully fledged, up and running in the next couple of weeks for you to be able to take it out to clients and provide your clients with the Bank Integrator value proposition. The new lifetime benefit has been a remarkable success, almost unprecedented, I'd argue. We've seen in a very short space of time, kind of 6 months since launch, we've now got 80% higher take-up than under the old lifetime benefit. And really, on the premise of the MedTech Booster, the understanding that new technologies are coming into the market whereby disability cover can be used to give you your lifestyle back, to give you a large portion of your pre-disability lifestyle back through these new cutting-edge but incredibly expensive technologies. And we can see that the current medtech protection that is provided to clients is at 36 billion rand from clients who have bought this cover over the last 6 months alone. We also launched our new income protection benefit, a really revolutionary benefit that converts automatically into whole of life protection, into frail care protection, long-term care protection, post age 65. So you no longer choose an expiry age. All ICB that you sell with Discovery is now effectively whole of life cover. And that adds on average 24 more years of coverage on permanent disability for clients. So this is the stat that we've calculated on all our clients that have moved from old and upgraded to the new version of ICB. They've effectively added on average 24 more years of protection through that permanent disability piece. From a child perspective, last year we launched our Global Education Protector, and then at the end of last year, our Child Protector benefit. Between those two, we are now covering over 36,000 children. And Marita will give you some more insight into some of the child claims that are coming through. These are incredibly difficult, emotive claims and difficult for families. And I think the ability to protect children, both against things happening to the kids themselves, as well as to their parents, is a remarkable suite of protection that can provide real, kind of comfort for parents that things can be covered at those very difficult times. From a shared value perspective, it doesn't only play out in terms of paybacks, but it completely transforms the entire ecosystem in which we operate. And I'll take you through what I mean by that. When you look at how the world has changed around shared value, that's enabled shared value, things like this proliferation of wearable devices. I think we tend to forget pretty quickly that if you go back 10 years, no one had a watch that could, on a real-time basis, cover and provide real-time feedback and data around your physical activity. If you go back 20 years, the only thing we knew about you was when you clocked into gym. We now know, and there's this seamless experience for clients that they're wearing watches, and that's all they need to do. The rest is simply done seamlessly in the background through technology. And that's been a remarkable enabler of the shared value insurance model. You can see 42 times more wearable devices compared to 2012. And you can see the trajectory of that growing exponentially. I don't think it's long until every single client has a wearable device as a matter of course. And that is a huge enabler of the shared value insurance model. And it's just so seamless. It means it just happens in the background. It doesn't rely on friction, on clients logging points, on logging activities. Everything happens seamlessly. And it obviously provides an enormous level of insight from a data perspective. When you add that to the rest of the big data that we've got across the group, and obviously with the bank, that adds a whole new level of data capability. You kind of shove that into a big data lake, apply all the new actuarial techniques, data analytics, machine learning, artificial intelligence. This entire ecosystem provides a totally new level of ability when it comes to transforming the experience at an individual client level. And then that technology doesn't only enable kind of the process up front, but also after claim. And I've talked about MedTech Booster and the ability for clients to access these new technologies that are coming into the market when they need them most. So I just wanted to take you through how we see it transforming the entire ecosystem, and not only through the shared value benefits like payback that you're used to. This is the traditional life insurance model. You apply for a policy, you go through underwriting. If it's accepted, the insurance company accepts premiums on a monthly basis, and eventually a claim gets paid out. Simple. Okay, that's the traditional model. When you inject vitality into this model, the entire game and ecosystem is transformed. Firstly, we no longer need to wait until policy application to gather information. Our clients are going for health checks all the time. We're gathering information all the time, and you can effectively swap those first two pieces around. And we're seeing that happen on a daily basis, whereby many of our clients, when they apply for a policy, have actually already given us enough information to do underwriting. In many cases, we can pre-underwrite clients and reach out to them proactively. we're seeing at this point in time that almost 1 in 4 clients that apply for insurance, we've got all the medical information required to actually activate that case immediately. There's no longer the need to call for medical tests on that application. And I think you'll see this play out more and more strongly over time as more clients are going for these particular tests. So you, right up front, you're kind of changing the entire game in terms of that new business application process and the seamless activation process that follows. Then, as part of that underwriting process, as you know, we're doing vitality health checks, either before the application process or as part of the underwriting process. And what this means is quite profound. Every single client that's going through a new business process, we're effectively getting a whole bunch of health metrics. These are the clients that are out of range over the last 2 years. So you can see 38,000, 28,000, 27,000 out of range for their various measures. Now, we accept those cases, okay, at standard rates, but we know that these clients are kind of have this impending risk. They've got high cholesterol, high blood pressure, high sugar. We can reach out to those clients and start sending them on a path towards managing that particular risk that they're exposed to. For the clients that are all in range, they then benefit through locking in discounts for whole of life. And at this point in time, those clients are saving 81 million rand every single year through being lifetime select, having all their metrics in range, and locking in that vitality rating discount for whole of life. On the other side of it, not only are the VHCs being collected, but clients are being encouraged and incentivized to go for screenings, mammograms, pap smears, prostate screenings. You can see the numbers there. Thousands and thousands of clients, this is just on the Discovery Life book, are going for these screenings on an annual basis. You can imagine how many of these are picking up early stage risks, early stage cancers, and genuinely saving lives. I know I get stories from advisors almost on a weekly basis where they sent a client just to get their points, and that client actually picked up a condition early and it saves their lives. I see some nodding heads. I'm sure you come across this from time to time, and I think it's a humbling experience because we tend to talk about things like paybacks, but advisors have often told me that the real point of all of this is that I know that by selling this kind of shared value insurance model to my clients, I'm genuinely saving and changing their lives. And that comes through very simply in pushing out those claims payouts. We're providing clients with this significant level of health awareness that they were never exposed to previously, and that sets them on a path to either go for the right medication, start changing their diet and their lifestyle, and that increases their life expectancy. We've seen about a 20-year increase in life expectancy for clients who are on the gold and diamond clients relative to the South African insured population. These are our claim statistics from last year. You can see 60% lower mortality rates for clients on gold and diamond in 2018 alone, and it plays out across the benefits as well, so nearly 30% lower on the disability benefit. And we show you these stats each year, and each year you tend to see the same type of patterns playing out. So when clients live longer, it pushes out that claims payment, and effectively that saves us money. We're now collecting premiums for longer, paying out fewer claims and paying out claims later. And that saving comes back to clients throughout their policy duration in the form of financial benefits like paybacks and cash conversions. And that's another way of thinking about what's happening in the shared value model. Through all this data, through all the ability to create health awareness and behavior change, you push out claims, we get more premiums, and we can then pass that saving back to clients through these financial rewards. As I said, payback of 5 billion, and last year was the first year that we've started paying out cash conversions. So you can see 38 million to date. We paid a cash conversion of over 7 million rand last month. And over the next 5 years, we expect to pay 2.2 billion rand in cash conversions. So you can see that's going to very quickly overtake paybacks over time. And when you put that all together, it's completely changing the paradigm of insurance. Insurance was never something that used to pay out except in the worst of times. But now, through changing behavior, through creating value in the model that never previously existed, we will now project to be paying 50% to healthy clients compared to claimants. It's a remarkable change in the paradigm of how insurance works, generated through this kind of shared value insurance model. The other place that the ability to use data kind of transforms the insurance industry is in the claim stage itself and picking up claims. You can see here's a case study where a client had a health integrated Discovery Life plan. He suffered heart failure, and we picked that up through his Discovery Health data. We then immediately notified his advisor, who then put through the claim, and the claim was paid and assessed as a Category A disability, and we paid nearly 3 million rand. Now, that's just one example, and in all likelihood, this client, given that it was a Category A, probably would have claimed in any case. But for me, the really interesting outcome here is of all our proactive claims that we've paid last year. So these are claims where we've gone and identified the claim and then found that client to try and pay the claim. You can see that almost 85% of these claims are actually in the categories D, E, F, and G. Now, for me, that's a very interesting insight, because Category A and B's, clients typically know that that's a claim. But things like, you can see here, 31% of them are in the I category. So things like retinal detachment, most clients don't even know that would qualify for a severe illness claim. Most advisors don't know that their clients even went through that. And it begs the question, how many claims in the industry go unclaimed for without this very unique and powerful capability to proactively go out there, use the data, and pick up all these lower severity claims and identify them and notify our clients proactively. And I think for those of you who have been through this experience, it is a dazzling experience for clients. It completely bucks the trend of what clients perceive insurance companies to do. I think most people think about insurance companies as doing what they can not to pay a claim. When you see an insurance company going out of our way to proactively pick up, identify, and notify clients around claims they may qualify for, it completely bucks the trend, and those perceptions are changed dramatically. In addition to that, the insight into data gives us a tremendous capability to design products in a very real way that accounts for the trends that we're seeing playing out. So these are some stats just from across the group that we thought we'd give you some insight into. Multiple claims are becoming more and more of a reality. Marita will delve into that in a little bit more detail later. But here, this just shows you from the World Health Organization. Sorry, that's the next stat. These are from our internal statistics. You can see that there's a 2.8 times higher likelihood of a heart attack once you've had a heart attack for a male, and over 5 times higher likelihood for a female. So you can see once you've had a claim, the probability of claiming again goes up in multiples. In addition, from a technology perspective, and I've talked about devices, this is a World Health Organization statistic. I had to double check it twice because I didn't believe it. But what it says is that 2 billion people in the world by 2030 are expected to need an assistive device. 2 billion people. Okay, at the moment, we're at 1 billion. That's 1 in 7. It's a remarkable statistic that are in need of assistive devices. And when you look at the types of technologies and devices that are coming out across the body systems, incredibly cutting-edge technology that can change people's lives, the problem is access. The problem is many of them are expensive, and only 1 in 10 people currently have access to those devices. And that's really the need around insurance, and ensuring that when this happens, clients have access to the absolute best and give themselves the best post-disability or post-event lifestyle possible. From a cancer perspective, that's another trend we're seeing and we've been reporting on over the last couple of years. I find this mind-blowing. The increase in prevalence of cancer since 2011, okay, 8 years ago, it's increased by 56%. All right, it's a remarkable statistic. Maybe Marita can give some ideas around what's driving that. We do know that one of the driving factors is earlier detection. More and more clients going for screenings and picking it up earlier, and that's a good thing. But we've certainly seen that even outside of that, there's been an increasing incidence and disease burden, particularly driven by cancer over the last few years. And then from a medical treatment perspective, I think many of you have seen the reports in the press here as well. You know, high-cost treatments, they're making incredible strides. The treatment of cancer in particular has been remarkable, but with it comes an incredibly high cost. Many of these new drugs that are coming out for cancer treatment are costing in the millions of rands per round of treatment. From a medical device perspective, you can see multi-million rand devices that are available on the market. So when you put all of these trends together, people claiming more than once, people living longer, and therefore the ability to claim many times, the increasing incidence of cancer, the associated increasing life expectancy post-cancer, but therefore the increased probability of cancer relapse. These are the types of incidences through data that our big data book gives us in order to design products that are not only appropriate now, but are taking these trends into account. And therefore, when clients buy products now, the products are appropriate for what's going to be happening in this space in 20 or 30 years' time. And that's why we've developed our products with unique features like multiple claims, like the cancer relapse benefit, like the global treatment benefit embedded in severe illness that allows clients to double their sum assured or increase it by 250% if they need treatment overseas for a particular condition. So there's a number of features that have been embedded into the product design that account for the trends that we're starting to see play out today. And Marita will color these in a little bit more detail when I hand over to her. Sorry. Can we just go back a sec? Okay. Something that we are really excited to launch today, which I will demo in a minute. I got ahead of myself there. But when you leave here today, you will find that we have launched a new claims website, which allows you to access all these statistics that you'll see in today's presentation in a new digital and interactive way. And we're really, really excited about this. I think it changes the game in terms of how you interact with our data. It gives you, as advisors, the ability to personalize and kind of delve deep into the statistics. I think many advisors, these presentations, these claims presentations, are the most kind of in-demand presentations. Every time I give one of these, I get hundreds of emails. Please, can we have that presentation? At the end of the day, clients and advisors want to talk through real stories, want to see relevant and personalized statistics, and we will be providing all of you the ability to work through these statistics with your clients in a very, very real way for those particular clients. And I just wanted to give you a brief demo on the new claims website and interactive tools that will be launching when you walk out of here today. So have a quick look. I'm going to talk you through very quickly some of the functionality that you can expect to see in our new Discovery Claims website. Okay. First and foremost, you'll see we have a real-time counter of paybacks and claims. You can then see all the global statistics that Marita will take you through today. It shows you the various tiles, different types of marketing material. You can go into the global statistics. You'll also receive those in a handout. But then you can personalize it. So let's say we choose a female 45-year-old professional, 2 dependents, and it will actually give you those specific claims and the claims that are specific to that exact client profile. Which is quite an interesting thing for clients to go through. It shows you the different types of benefits in tiles for those clients. So you can see if we go into income protection, You can see the different claim statistics that those clients are exposed to. So it's musculoskeletal. You can also see there's interactive content and videos and case studies that you'll be able to watch at that point in time for various clients. If you go back into life cover, for example, you can then drill down into a more granular level. If you want to look at the unnatural claims and how those are broken down for those clients, you can see how that plays out. So an incredibly granular level of data. In addition to that, we look at child and family sections. We can look at the Global Education Protector, child's severe illness claims. And then really exciting, I think, we pre-populate the quotes and the cover that clients like you might have. You can change that around and you'll see the premium that that client will pay is pre-populated. There's also a vitality section where you can see how engaging in vitality increases your life expectancy, reduces your mortality, as well as pays your paybacks and cash conversions. You can also send this as an advisor and share it with your client. So you can fill in their exact profile and send a link to that exact client profile to your client. So I think a remarkable new website. When you leave here today, you'll see a QR code on the handout on our claims booklet. And if you scan that QR code, it will take you to the very first version of this new Discovery Life Claims website. So something we're really excited about and hopefully add some value to you in terms of taking the power that is sitting within this data and these statistics in a usable way out to your clients. Without further ado, I'm going to hand over to Dr. Marita to take you deeper into the data, deeper into the numbers. But once again, I just wanted to thank all of you for being here today and more importantly for your support. And we look forward to working with you further over the next few months. Thanks very much.
Good morning, everybody. So part of the claims insights today is to show you how the promise that we give to you and to your clients at new business stage pans out over the lifetime of the policy. And it must be one of the most rewarding circumstances in life where you can really make a difference to your clients when disaster struck, when they have been diagnosed with a terrible disease or trauma or whatever. And over and above the emotional support that you give to your clients in any event, you can provide some financial relief that will help your clients to recover or deal with whatever they have to deal with. So this is what we paid out in 2018, over 4.2 billion rand. I'm just going to touch on the high-level ones. More than 2 billion rand in life cover paid out, almost 1 billion in severe illness, and over 700 million in capital disability, and then all the other benefits. So there has been a lot of publicity about claims not being paid, about non-disclosure, and so on. We have only declined 3% of the claims submitted. 3% is really a small number. And if we break that down, policy terms or conditions not met by far the most common reason, 76%, that would be somebody has not suffered a heart attack according to the contract. It was angina, maybe unstable angina, but it did not meet the criteria for a heart attack. Those are the kind of policy conditions not met. Pre-existing conditions and other exclusions, there's normally a very good reason why we exclude a back problem, because it will be a problem in future. So these are the kind of either pre-exclusions or an underwritten decision. Non-disclosure, Of course, it's very, very important, and I think recent events in the media has highlighted how important disclosure is. But I can assure you that these claims are being looked through very, very thoroughly and from all angles, from compliance, from legal, from medical, from underwriting, from claims. It is not a decision that is taken lightly. It's got to be material to the issuing of the policy. It's got to be a reasonable decision. And if you look at it, it's 4% of 3%, okay? It is actually a very, very small number that is repudiated on grounds of non-disclosure. And then other reasons, premiums not being paid out of force, that sort of thing. We have a very good track record with the Ombudsman. We have few claims in proportion to our market share, and we do much better than the industry standard in the determinations of the Ombudsman. Okay, so if we look at life cover, sadly, in our young ages, trauma and unnatural deaths are still the bulk of the life claims. Older ages is more the disease process, the heart attacks and the cancers and the strokes and so on. If we look at just specifics, the oldest male claimant was 86-year-old, and he died from cancer. The oldest female was 88, and she died of a heart attack. Our youngest male claimant died at the age of 21. It was actually cardiac arrest, which could be many causes, not necessarily the traditional heart attack as we understand it. Youngest female, 28, in a motorbike accident. And then, interestingly enough, the death claims were often preceded by a severe illness claim. In 286 of our clients, either severe illness or capital disability. Average policy duration before a claim is 9 years. It could be as soon as the day of the inception, or up to 18 years after the policy was taken out. If we break it down in female and male causes of death, for females, definitely cancer. And we must remember that breast cancer is the most common female cancer. And unfortunately, it's actually scary to see how young females get breast cancer these days. It's difficult to say why. There's obviously in the younger ages a genetic component. We all know about the BRCA1 and BRCA2 genetic mutation. But even if you take that out, it's a small percentage of people that actually carry the BRCA mutation. Even if you take that out, it's still quite a high incidence in young women. So I think that's why every person should take out severe illness when they're actually young and healthy, because as we'll see from the stats, it can happen at any age. Second after cancer is heart and artery, and after menopause, the female population unfortunately catches up on the male incidence of heart attacks and strokes. So still quite a big proportion, but not as big as in the males. Cancer, then second most common cause of death in males, and then males more higher percentage of unnatural causes than females. Maybe they drive longer distances, they drive more often, or they have hobbies like flying and other sorts of things, but unnatural definitely more in the male population. It is so that the female deaths due to cancer is declining, and Gareth has touched on that. And the reason is probably earlier detection and better treatment. And as we know, the better treatment comes at a very expensive price. But what prices a life? What prices if you can be treated and you can see your child getting married, or you can be there for the birth of your grandchild, and you can enjoy a good quality of life for much longer? There is no financial price on that. So let's hope that with earlier detection, better treatment, that we can continue with the trend. We are also seeing a downward trend in unnatural deaths, fortunately. It's still too high, it's still far too high, especially in our young clients. But this could be due to our book getting older, that clients, fortunately, as you've seen, our lapse rate is low. So the average age of the book is getting older. And we know that in the older ages, the unnatural deaths are lower, so that could be a factor. We would hope that the Vitality Drive and the availability of Uber and the Gautrain and other Vitality Drive aspects would come through in reducing the very tragic stats in our young client base. If we look at unnatural deaths, motor vehicle accidents still by far the most common. Sadly, suicide rates are way too high, and that's a worldwide phenomenon. In America, they're battling with the opiate overdoses, they're battling with suicides, and so on. So it is a worldwide phenomenon that suicide incidences are rising. Other accidents, aviation, drowning, and so on. And then, sadly, again, 16% are crime-related. So we're going to touch on access cover now. 43 million rand was paid out in access cover claims. As Gareth have mentioned, slowly but surely the payouts are rising on that. There's a case study for us. Ross took out life cover in November 2008. He was diagnosed with cancer in April 2018, so 10 years down the line. And he was only 35 years old at that stage. The specific cancer here was colon cancer, and that is another phenomenon that we see worldwide, is that colon cancer, while it was always an older person's disease, is now occurring in younger and younger ages. So much so that the World Health Organization is actually looking at screening guidelines. And obviously, if there's a family history of colon cancer, the screening process has to start earlier. So definitely also something to bear in mind. He didn't have severe illness cover, but because he had an advanced stage colon cancer, he could access his life cover. 60% of his life cover, that was paid out, and he received over 2 million rand that he would not have had to pay for whatever the final stage of one's life's needs are. If we look at capital disability, I think you're very familiar with the capital category A and B and C and D. Category C is still a unique discovery feature where people would get a small percentage on an ongoing basis while permanency is established. Severity D is our occupational-based underpin, where A and B, of course, is our medical definitions. On the right-hand side, if we look at the age of our claimants, that would include all categories. But look how young some of these clients are, even in their 30s, even in their 40s. And look, we are talking about disability, which is normally permanent. That is the hallmark of a disability claim. And people will have to live with that disability or impairment for the rest of their lives. So at least they can cover their debts. Maybe start something new. If they can't do their nominated occupation anymore, they can start an alternative business or occupation. And actually, when we expect it at the ages of 60 and above, it's actually a smaller percentage than in the Middle Ages. Middle age where you still have kids to put through university, you still have a bond to pay, you are not as financially secure as in the older ages. There is, and I had to do a double check on this one, just like Gareth had to double check on other aspects. 2.3 billion in converted severe illness is currently in force. So by the time of the expiry date of the capital disability, the disability converts to severity A and B severe illness, which is a very valuable feature, because by that time you can actually not access severe illness if you're over the age of 65. So that is one way of where you don't need disability so much, but you need severe illness. We have paid 32 plus million in converted severe illness in the last 3 years. Category C, which is the smaller percentage on an ongoing basis, 30% or 34% of those clients actually received an ICB payment as well. On our lifetime booster, the average amount that was boosted was 24%. So if we look at Matt's case study, he took it out in 2011, and in 2018, disaster struck. He was in a tragic accident, had his leg amputated, and he qualified for 50% category B payout. That was 5 million, over 5 million rand. With the lifetime boost, he qualified for a 45% extra, and that equated to 2.4 million rand. If he had the current lifetime 300, he would have received 16 million upfront and a further 10 million over the next 15 years. So that brings us to the MedTech booster, where there is the lifetime 200 and the lifetime 300 with a relative small increase in premium, but very rich value. The tiers are linked to what it would cost for the MedTech, the bionic leg, the assistive device for the heart action, and so on. We also have the feature that the Cat Bs are automatically increased to the category As. And that makes financial planning much better and easier and more certain. That if you want to cover debts with your capital disability payout, you will know that it will be 100% payout for the defined definitions. We've touched on the upgrade. That would, if everybody had the upgrade from a category B to category A, that would on average be almost R1 million more. So if we look at these assistive devices, they are very, very expensive. In 2018, we had the following claims that if they had the latest capital disability that was launched towards the end of last year, that they would have had the extra MedTech booster of 120,000 rand for visual improvements. 31 clients would have qualified there for that. For heart-related conditions, 4 clients would have qualified for that. Amputated arm, hand or leg, 15 clients would have qualified for that. Hearing loss, 24 clients, 29 clients for paraplegia, quadriplegia, and arm, hand or leg, 51. And as you can see the numbers there, it is so expensive. There are very few people who can just dip into a savings account and come up with R1 million to pay for an assistive device that will bring back some quality of life. If we look at severe illness, obviously severity A is the bulk of the amount paid out, but as Gareth has also alluded, the E, Fs and Gs is a substantial portion of payouts. The early cancer benefit sits also in the lower severities. It is not quite as life-changing as stage 3 or stage 4 or even a stage 1 or 2, but it does bring added surveillance, further insurability, and treatment to a client. And also just the mere thought that I have had an early cancer is an emotional impact on a person. And we have paid 1.5 million rand in early cancer claimants since the launch of this product. The lifetime 100% severe illness benefit makes sure that even stage 1 or stage 2 cancers top up to 100% of the sum assured. I must say, I think everybody should be on at least 100% lifetime, because you might be lucky in a sense that the cancer was picked up in a stage 1 and your prognosis is better, much better than a stage 3 and 4. But with new treatments and with new advances, the costs of the treatment, the cost of the additional expenses can be so much that if you can choose, it is better to have the top up and have the 100% and have certainty on what the payout will be. The 200%, even higher top-ups, we can see on the graph that the minimum payment would be 100% for cancer, but on selected benefits, the actual payouts will go up to 200% for certain of the definitions. Another case study. This is a young doctor, and typically, cervical cancer strikes in the younger age groups. She was diagnosed with cervical cancer. She would have received a 25% benefit under a severity D, but because she had lifetime, she had the severity A or 100% top-up, and that was 2.8 million rand. So we are paying a lot of these cancer benefits that have been upgraded. It launched end of 2016, and we also had a very, very good uptake on the lifetime, so that we have many, many cancers that are being upgraded from a severity D to a severity A. And it's always very rewarding if we look at these claims, and it does actually not matter that much if it's a stage 1 or a stage 2, because the client will get the 100%. Okay, so age again. Severe illness strikes at any age. We've now touched on the cervical cancer. On the male side, testicular cancers, young guys in their 20s diagnosed with testicular cancer. So it can really happen at any age. Even in our kiddie claims, childhood cancers, young people, and then of course from the age of 40 we get the spike, and then again even a little less over the age of 60. Again, as Gareth alluded to, severity E, F, and G, quite a big percentage of clients get paid under E, F, and G. Body systems, although we know that cancer and heart attacks, strokes are the most prevalent, highest incidence, all the other body systems are affected. So it's very important to get the broadest range of cover for your client and not just go for a product that just offers the main body systems. We have touched on the breast cancer claims. You can see that breast cancer is by far the leading cancer in females. Other female cancers, as we said, ovarian, cervical in the young age groups, ovarian older, uterus, and so on. So those are the female cancers. Interestingly enough, in males, skin cancer claims are higher than in females. Maybe they're just exposed more to sun with either recreation or work, or maybe they should use more of the sunscreen. But of course, in South Africa, with our sunny climate, which is wonderful, we must really be careful and use the sunscreen, use the hats, and stay out of the sun over the mid-period of the day. Males, prostate cancer, a little bit more in the older ages where we can expect it. In the younger ages, as I've mentioned, testicular cancer. And then all the others, prostate, testicular cancer, bladder cancer, older males, and so on. This is a product that's very close to my heart because we could identify where people had the older cancer benefit on their severe illness. They have been paid out 100% or a lower severity, say a severity C, and then they go into remission, thankfully, but then after a while, there's a remission. After the remission, there's a relapse. And with the relapse, very often, because cancer is paid as a progressive claim, once 100% has been paid, there is no further higher progression. Or if it relapses after a severity C payment and it's now a severity D, there was no further payment. And as we know, if there's a relapse after remission, the cancer comes back more aggressively. And you have now used the first line of treatment. So now you have to go to the second line and the third line of treatment, which is more expensive. And this is why we introduced the cancer relapse benefit. It was definitely a first in the world. Not many people have introduced it since then, but I think it is a very, very valuable feature to have as part as cancer protection. Just on the early cancer benefit, I really believe that we have the most comprehensive early cancer benefit. I know that many companies do not pay for malignant melanoma in situ, which is probably the most common in situ because you can see it. You can see a mole changing. You can see it changing your skin. And very often that's not covered by the competitors because it does come at a cost because it is so common. Another thing just from a medical point of view to bear in mind is the terms and conditions for the early cancer claims. Very often competitors will pay for early cancer, but only if the whole organ has been removed. For example, early laryngeal cancer, which is the voice box, and the common treatment would be laser. It would be not full surgery. And many of the competitors will only pay for early cancer if there was quite invasive surgery done. So that is another thing to bear in mind if you're looking at cancer benefits. Multiple claims in the market, I think that has been our competitive advantage for a long time. For unrelated claims, many of the competitors would pay for a lower or the same or the higher severity, but they will limit the amount paid out to the selected cover amount, where Discovery would actually pay more than the sum assured, the initial sum assured. On the related claims, most of the competitors will only pay for a higher severity the next time around. And we will look at the claim and we will look at lower severity, the same severity, or higher severity, and the maximum is not just the sum assured. So I think that is a very unique feature, that people can actually get more than the original severe illness of whatever it is. Let's carry on and look at the multiple claims. It is so that once there is a weakness in the body, for example, ischemic heart disease, which is heart disease that spans from angina right to devastating myocardial infarctions or heart attacks. Once that weakness is there, it's actually a continuous disease process. And it's only with very, very strict risk factor control that you can stop that disease process. So 1 in 5 clients is on their second claim, and very often in the same body system. 72% of our claimants is claiming for the second time, 18% claiming for the third time, and then 10% claiming for the fourth time. And as the book matures, and as our clients get older, and remember, these clients cannot get other cover in the market. So they are staying with us, and they will have the value of multiple claims. We have paid 12 severe illness claims on one client in 2018. He actually has very, very bad heart disease, and he had a coronary artery bypass and so on. And then it continues. It's almost a yearly claim. Okay, so heart and artery, we really have the most unique feature where every claim for heart and artery after the period of 30 days, only 30 days, is seen as a new event. So that's paid as if it is the first claim. I don't think there is any other company in the world that pays heart claims like we do. Cancer claims, obviously, progression of claims, relapses of cancer, and then also unrelated claims or seemingly unrelated claims, but it could be in a sense related because of the previous treatment, because of previous chemotherapy, because of previous radiotherapy, or environmental or genetic causes that continues throughout the life of a person. Nervous system, obviously, we have a tiered progression, and we will pay as the disease progresses. Most of the body systems can have multiple claims, and it is because of the continuous disease process. Same body system, almost 50%. So that means if you are excluding or you're capping at a certain severity level, that 50% of your multiple claims would not pay if you do not have this feature. So this is our claimant in 2002. He came on board and he took out a life plan with severe illness. He required a bypass at that stage, and he qualified for a 75% payment. They could actually not do all the bypasses that he required because of technical difficulties. And so in 2011, they attempted it again and they did another bypass where we paid 50%. And then from 2013 to 2018, he had lots of angioplasties and stents and minor procedures if you compare it to a bypass graft. But if you think about it, go into hospital, have an angiogram, have a stent, it is actually not that minor. And he have had all these claims paid as if each and every one was the first claim. With a 100% minimum protected fund that he did not have, he would have received over 2 million rand in claims over this period of time. And it was all in the heart and artery system. If we look at our family benefits, we have paid out 14 million rand under the automatic child severe illness and the parent care benefit. These benefits are automatic. People don't even pay that much attention when they take out the policy unless you tell them about it. But when your child is sick and you have to take time off to care for your child, or your parent is sick and you have to take time off, then it is really a valuable benefit to have. Average age of child claimants was 6. Most common condition is development delay, which is almost like a catch-all for many various diseases and traumas and conditions. Unfortunately, we see quite a number of child cancers as well. We have done away with staging and paying according to stage because childhood cancers are totally different to adult cancers. And if your child has got cancer, anything less than 100% is actually not enough. Again, severity is in E, F, and G. 35%, and then A to D, 65%. Shows the value of the comprehensive cover once again. The average age of parents' claims was 68, which is actually young. You would think of older age parents, frail, where they need care. What this is showing that probably because of cancer claims, heart claims and so on, that can happen at a much younger age, meeting the ADL requirement, meeting the severe illness benefits. It's only 68, and 68 today, if we look at the life expectancy, is actually quite a young age for parents to need that level of care. We have now cover under the purple plan. It's obviously more under the auto child cover. 150,000 rand for kiddies and a little bit more on the purple plan, and then also for parent care 100,000 rand. But now with the new child protector benefit that came in, it is the ability to purchase up to 3 million rand cover for a child, which is substantial. If you need to go overseas to get the very best cancer treatment for your child, or the best rehabilitation, or whatever there is that you need, then you will have the finances to facilitate that. If we look at ICB, I always say it's the self-employed person's sick leave. We have paid temporary ICB is in the sum assured 33%, although it is in numbers far more. It is an expensive benefit if a young person becomes disabled and they are now permanently disabled. So that is why 28% of our ICB claimants that are permanently disabled contributes to 67% of the total payout. And we have reserved 1.5 billion rand for our current permanently disabled clients. As you can see, even young clients in their 20s can have a need for ongoing ICB. Fortunately, most of the younger clients do recover. It's good to go back to work. It's good to earn an income. It's good for the person. It's good for the family. It's good for the economy. So if we can get people back to work, we do encourage that. But if they can't go back to work, there is at least financial relief for that. Once again, ICB, as we've seen with severe illness, as we've seen with capital disability, there is no one system that is the only system that leads to disability or claims, and also not an age group. So it is spread over all the age groups, over all the systems, and male and female. It does vary a bit. Female claims it's a bit more under mental and behavior, but unfortunately we see completed suicides in our life stats on males. So that is something to think about. You know, do the males not seek medical help and treatment when they should? And it sadly results in more completed suicides. Cancer, again, on the female side, slightly more, and on the heart and artery and the musculoskeletal, more male incidents. Contribution protection, we know that to pay your medical aid and pay your insurer and short-term insurance, it can add up to quite a tidy sum. So if you qualify, there is the contribution protector that will, up to the value of 33% of the sum assured, pay for all your other premiums for a period of up to 24 months. We have a case study, Caroline. She's a dentist. She had bad trauma. She had a lower back injury. And with her contribution protection, she could afford to carry on paying her other premiums. She received over 1.3 million through her income continuation benefit, and is further 100,000 for the contribution protector benefit, which would help to pay the ongoing premiums of the other products. We now have the maternity premium waiver, where some of the life plan premiums are waived for a 4-month period after giving birth or adopting a child. And we also have the family protector that pays for 6 months if the spouse or the children are diagnosed with a severity A or B condition. We have a case study, Bill, he's an auditor, 34 years old. He has a 5-year-old daughter. Unfortunately, this daughter was very sick, and she was diagnosed with a lung condition, and she was hospitalized, and she qualified as a severity A, and the family protector benefit kicked in, and it covered 6 months of his income to the value of 252,000 rand. Valuable time to spend with your sick daughter, helping her to get better and taking the financial pressure off a very, very sad situation. Our global education protector. You can choose public schools in South Africa, private schools in South Africa, or on the dollar plan, international schools. And with our university product, University Funder, which was granted a prize, an international prize for the most innovative product, you can be assured that your kids' education will be taken care of. If you claim, obviously, there is the benefit, the protector that kicks in. If you do not claim, and according to your vitality status and the length of the time of the policy, you can fund your kids' education even in an international facility, which is amazing, amazing benefit. I don't think you can give your kid any bigger gift than a proper education. Money, easy come, easy goes. Money is no guarantee for a successful lifestyle, but a good education is. At the moment, we have 34,600 odd kids covered under our individual policies, and on the individual and group risk side, we have 1,450 children that we are paying for under the Global Education Protector already. So the future education, as I've mentioned, through vitality engagement, 1.9 billion already earmarked, projected to be funded through university funder benefit. I think that is an amazing benefit. So you will get in your handouts, you will get the overview of claims and rewards paid. You will get access to the new website. It's all now digital, so no more stocking up bulky files, but you will have it all online. And then, as we have mentioned, as Gareth has demonstrated, the new claims website that you will have access to and that you can forward to your clients. Thank you very much for your attention.